Welcome to tonight's asset protection webinar on case studies for the stock market investor. So many people get involved with investing, and they get excited about making money, and that's really, really good. I don't want to diminish anything, but sometimes they're leaving so much on the table where they don't know how to protect what they're currently doing. How to use simple limited partnerships or LLCs or corporations. And so that's really the breadth of what we're going to try to talk about tonight. And I'm excited to have Mike and his expertise coming on. So thank you for being, if you're new to us, this webinar series has been going on for over 10 years now. This last year, we've had Scott Estel, the former senior trial attorney from the IRS. A couple weeks ago, he was comparing the Trump and Biden tax proposals. We've had Dr. William Danko, the author of The Millionaire Next Door, talking about how
he was definitely talking about something.
Well, it sounded good for a minute.
A hot second there.
Hot second.
To do this without leaving your family.
Don, can you hear me okay?
Yeah, hopefully that's going to get a little bit better. You know, one of the other things that while Don's working on that a lot of new investors they think about is, or they forget about is, how can I make X amount of money on a trade? If I do a cash spread, if I buy a stock, if I, do some cover calls, if I collect some, money from doing whatever type of a trade you might be into, we forget about the fact that some of that making money isn't just how much money do you make on the trade, but if you can save an extra 6, 7, 8, 10% a year, strictly just off of cutting your taxes down, that's a huge amount. You start to compound that. I'm not sure what Don's got going on there.
He's getting better. He's switching out. So, there we go. It'll go away for a minute. We got some background. So thanks for that. I got some feedback and echo there. You okay? Can you hear me now, Mike?
Yeah, I can hear you fine, just fine. So what I was saying is, a lot of times it's not so much how much money can I make on a trade, and that's what everybody focuses on when you first get started. Can I make, if I write this cover call, can I make 5% a month every month for the next year? Well, that'd be great, but like Don was saying earlier, first we have to learn how to also protect it in case it doesn't work out our way. And then two, what if I can actually make some money just by cutting down my taxes? I mean, that's actually making money as well, because we know that the government's in every part of our business that we have with this. So if we can actually minimize some of that at the same time, can we make an additional, let's say we get an extra 10% a year, and over the course of 10 years, you start to compound that, you're up about 120, 130% more on your portfolio just over 10 years, simply because we were able to minimize our tax rate. So there's all kinds of cool things to do this, not just about how much money can I make on an individual trade. I think that's what we're going to talk a little bit about tonight. Plus I have a couple of good picks for you just in case you're looking for those too.
Yeah, so definitely more on the legal structuring side and the tax side. Don will definitely cover that. Gosh, and who knows? I mean, obviously we're in the middle of this whole re-election thing, and everybody's scared about taxes, how that's going to go. Well, we don't know. It's tricky. So, yeah, I'll let Don jump on that. He's getting on now. Hold on one second here, Mike.
Okay.
All right. Kendall's loading the presentation, and we're using his computer. So if you're new to us, this webinar series has been going on for a very long time. And we've got in our website, protectwealth.com, hundreds of recorded hours of webinars. And Mike's featured on multiple ones. And so we invite you to take a look at that. We also are getting ready for a big 3-day asset protection summit coming on next week. And so we invite you to be part of that. That's where we're bringing in some of the best attorneys in the nation. Mike and Stacy will be presenters at this, as well as multiple other people on wealth creation. And then lastly, before we get into any specifics, we can't, in a setting like this, give specific legal advice to anyone, any group, or any individual. We can teach concepts that are general by nature, but how they apply to you in your situation, I don't know. That's for someone else. All right, so we've got presentation back up, And hopefully you can see that. Mike, can you see the presentation?
I see it just fine. Yeah.
Okay. All right. So let's move forward. Okay. So if you're looking to, if you're looking as a trader, you want to save money on taxes. You really have three options. We could clicky thing. We could do nothing. And if we do nothing, and that's actually okay for a trader that's just getting started. Maybe I don't need a lot of tax advantages.
Well, if you're a brand new trader, you're 18 years old, or you're a young kid, and you're making $5,000 or $6,000 a year, and that's all that you're making, it's okay to do nothing at all for an options trader. And even if you're a brand new trader, because let's say you're just now getting started, you don't have to do something right off the bat to get started in the stock market. A lot of people say, well, I want to make sure I've got everything set up, I'm structured, I have all my LLCs in place, and I have got all my accounts open up properly, and I want to make sure all the forms are done. You don't have to do anything right off the bat to get started in the stock market. If you get started and your first trade's not going to be closed out for 1 or 2 or 3 months, you don't have to do everything that's out there. You can just do like Don's saying here. You can just do nothing at all if you want. It's not going to affect you that much. Maybe you're going to have to pay another $45 in taxes that year because you've got structured 2 or 3 months late. But usually, as you get into this and you start saying, okay, if I'm going to be making over $10,000 a year in profits through trading, which isn't that difficult, then at that point, you really want to make sure that you've got some type of structures in place. So,
and we wanted to leave this.
One is do nothing is correct.
Well, we wanted to leave this as an option because what we don't want to do is for people to not get involved with trading, going, oh my gosh, should I be a C Corp or an S Corp? Should this be a limited partnership or an LLC? Or oh my gosh, and you never get into trading. We want you to get into trading. There's some good money to be made in trading, especially when you know what you're doing. But to get started, for some of you, that might be the very, very best way to get started is just trade as an individual, and then we can add on the legal structures and the tax savings later. But never do we want you to let the legal structure get in the way of making money. Is that fair?
Remember that part of it, you're making money. So if someone came up to you and said, well, I'm going to allow you to make $45,000 this month or $30,000 this month, would you turn either one of those down? And the answer is no. One is just you paid extra in taxes, one you didn't pay extra in taxes. But if you still have to pay the taxes, that means you still made a profit. So you should, like we're saying here, don't let not having everything in place stop you from actually getting into investing. And whatever that investing style is really up to you. But do nothing, but at some point you're going to want to make sure you are structured properly so you can start saving. But don't let that hold you back from actually getting into the stock market, especially now with what's coming up here. There's going to be a really volatile market here for the next 12 months. Really volatile. That means both up and down swings pretty heavily. There's going to be lots of money to be made, lots of money to be lost. And so now's a good time to actually get into the stock market because it's when it moves, that's what allows us to have those profits. So.
Okay, so option 2 is to qualify as a trader, and I'll give you some ideas on that. But unless you're a full-time trader, you're probably not going to qualify, especially if you're doing this as a side job. But I'll give you the pros and cons of both. And then the third thing is to create a trading business. So let's kind of walk through those options. If we do nothing, you can deduct your brokerage fees and the cost of trading. What you can't deduct is because you're the owner and you really don't have a business, you're not a full-time trader, you can't deduct computers and trading and software and your cell phone, your internet, all the expenses that may go along with the business because frankly, you don't have a business, you're simply trading your own brokerage account. Now, again, that may be the way to get started, but for those that are making money, it may not be the very best option for you. Option number 2 was to qualify as a trader, but the problem with qualifying as a trader is that the IRS has issued really arbitrary guidelines as to what constitutes a trader. Now, don't mistake the word trader for trader. It's very, very different. The spelling is different, and let's not go that. We're talking to somebody who's trading in the market. Anyway, so, but to be engaged in the business, here's what the IRS says. Here's the three requirements, and look at this and tell me if this is arbitrary. You must seek profit from a daily market movements in the prices. Okay, so that's so we're not looking at long-term year trades. We're looking for daily markets in the movement. Your activity.
You're looking at intraday trades or 1 or 2 day trades, but not more than 2 day trades. So if you're in a trade for a week or a month, that doesn't qualify. So it's got to be 2 days really or less. So most of that is an intraday trade is what they're after. And on average, they're looking for at least about 1,000 trades a year.
Yeah,
you can't just be in the first 1 or 2 months, but that 1,000 trades has to be throughout the entire 12 months. You can't say, I'm gonna just take the last half of it off because I had 1,000 trades. It doesn't work that way.
It has to be continuous, regular, and substantial, but they never say it has to be 361 trades or 1,000 trades. They leave it in this arbitrary term that all they say is it has to be substantial. Oh my gosh. How do you determine that? So
yeah. And let's suppose that you did think that you were qualifying for that, and so you're actually saying, I'm just going to write all this stuff off, and so you try to write it off, and then you get audited, and the IRS comes back and says, nope, you didn't qualify. Now you got to go back and pay your penalties and taxes on top of all that. It's not worth it to try to qualify as a trader. It really just isn't. It's so much easier to form some type of a corporation.
Yep, I agree. So the test case that we'd like to refer to is the Chen case, where in 2004 he did 323 trades. I would consider that to be substantial, but he did the majority of the trades in 30 days. 100% of his trades were in 6 months, and then he took the other 6 months off. 86% of his trades were made over a 2-year period of time, so it was not continuous and regular. I think it was substantial, but again, that's an arbitrary. The IRS came back and said, nope, he didn't qualify. All of the deductions he took for that year, they denied and said, yep, he's not continuous. And the court also noted that he had another job. He wasn't a full-time trader. Therefore, they went back and denied all of his deductions that he had claimed that year because he wasn't a trader. So if you can't qualify as a trader, what option do you have? And Mike, you just nailed it. We create a business for the intent of trading. So Mike, you started out very similar to the way I started out. We were both in the grocery business way back when. You worked for Safeway, I worked for American Stores. We were in the management program and we were moving forward, but eventually you got out. At what point did you become a full-time trader?
Well, right off the bat, from my very first class, I actually opened up a C Corp from the day one. That was just what they taught us to do in my class. It was really beneficial. You know, had I not known that, you would just be out there trading under your own personal name, paying the extra taxes, not knowing any different, being subject to, you know, any type of lawsuits that might come up at the same time, not being able to write off a lot of your different expenses. So I did it right off the bat. But when I took my first stock market class, but when I first got involved in the stock market, it was really through Safeway as a grocery manager, and I was just buying Safeway stock throughout the 401k that they had.
So you never, even as much trading as you do, I'm sure you can qualify as a trader, but you just have the C corporation, so you don't have to meet that qualification.
That's correct. And just like you said earlier, you know, what if you think you're doing anything correct and the IRS just says nope, just because it is so ambiguous and you just don't know if it's correct or not, and say no, you don't qualify. I mean, set up your C corporation in less than a day and it's done, and you don't have to worry about it ever again. And you know at that point that you're compliant all the way through. It's going to be simpler. It's no headaches at nighttime. You can sleep at nighttime. So get it right from the very beginning. You know, it takes you a day. It's not that difficult. You know, Don, I know that you help people set up with that with Anderson as well, but it's something that can be done really easily. You know, even if you don't get it, you know, your first day that you start in the stock market, when you start investing, or you've already been investing for a while, that's okay too. You know, start it when you can, but at some point you're going to want to get it out there just to be able to save some of that. Question here that that Jesse just asked is, if it's a business trading account under the name of the LLC and not your personal trading account, can you deduct all kinds of your expenses? And the answer is yes, you can. And so that's really the whole goal of what you're trying to do, is to be able to deduct all those expenses so that you don't have to pay for them. And business has it so much easier than an individual. As an individual, you make your money, you take out your taxes, and then you pay for things with what little is left over. Businesses are just the complete backwards side of that. They make their money, they pay for everything, whatever's left over, that's what the taxes are paid off of. And it's just a huge benefit to go back and do that.
It's a very, very different set of rules for businesses and for those who have a business and those who don't. Okay, so generally, here's how we would structure a trader. We use a limited partnership. We call it a family limited partnership because it's owned by family members. It may very well be an LLC. We like multi-member LLCs because they tend to be more stable than a single owner LLC, which could be construed as a alter ego of you for the courts and could be taken away. So we'd like to have multiple members. That could be family members, it could be a husband and wife, it could be a niece and nephew, it could be, we like multiple multi-member LLCs or family limited partnerships. And in these diagrams, I'm going to use the word FLP or family limited partnership, but know that in a lot of cases that may very well be a multi-member LLC. We do that so that the trading account can't be taken away from you in a lawsuit. If you do something wrong or you're accused of doing something wrong, either way, you're going to lose a lawsuit. The FLP had nothing to do with that, and whoever gets the judgment credit, your judgment creditor can't come in and take the assets out of the family limited partnership because there would be other people involved with it. And so we like the family limited partnership for asset protection. And then we set up a corporation. The business purpose of that is to manage investments. Now that could be stocks and bonds, it could be options, it could be real estate, it could be pork bellies, it could be whatever. We're going to leave that business purpose very broad and open so it gives you flexibility. The business purpose of the limited partnership would be to own investments. And again, that's a very broad term, but we like broad terms because of the flexibility. By using the combination of the corporation with a limited partnership, you can achieve both asset protection and really good tax advantages. And let's kind of discuss how that works. Your corporation, what it does is it manages the affairs of the partnership for a reasonable fee. Well, what's reasonable? Again, the IRS doesn't really define that. It just says it has to be reasonable. Mike, let me ask you, would it be reasonable if you charged me 1 or 2% of my assets in the limited partnership to manage my account? Would that be reasonable?
Yep.
What if I paid you like $40 a trade? Would that be reasonable?
Yes, that's reasonable too.
Okay. What about $200 a month to manage my account? Would that, depending on the size of the account, would that be reasonable?
No.
No?
No.
You wouldn't do it for...
It's too low.
Okay, well, okay, there we go.
I'm not saying it's too low for me. I'm just saying, but yes, it's reasonable because it's the price wise. But if you can get somebody to do that for $200 a month, that would be a fantastic deal for you. But yes, that would be reasonable. Yes.
And if it's your corporation and you're only charging $200 a month, that might be reasonable because of what's happening in the account. Would it ever be reasonable for me to pay you 40% of the profits, Mike?
No, that's not reasonable.
Well, what if you were tripling my money every year?
Then that would be reasonable.
Then I would. So that reasonable is very arbitrary to what's going on in the account. The IRS just says it has to be reasonable, but they don't really define what reasonable is. And all of this would be explained in your management agreement. And that's normally, it's going to give the corporation authority to trade. It's going to spell out what the fees for services are. there's going to be a disclaimer of losses. If Mike were managing my account, you would have all those things in here, wouldn't you, Mike?
Yes, that's correct.
Who's
You have
gonna
it
pay
spelled
the
out in the
tax?
document.
Yep. And so most of you, when you're setting up an LLC or a family limited partnership, and we're giving authority to the manager or to the general partner to trade, those things would be in. We don't necessarily need a separate management agreement, although it would be it's certainly okay to do that. The only concern that I have is that if there's something in writing, which there needs to be, that you follow that management agreement. Let's say Mike agreed to trade my account for, or you set up your corporation and it's agreed to set up to charge $500 a month to trade this account, and you're going along fine. But then I just had a couple months where I just didn't make any money, so I'm simply not going to pay the corporation because it didn't make me money. Well, that's not according to the agreement. Mike wouldn't continue to manage my account if I stopped paying him. So whatever it says in the agreement, if you have to go back and alter the agreement, go back and alter the agreement. But whatever it says in writing, you really should follow that, or it kind of screws up your asset protection. I hope that makes sense. Mike, any comments on that?
No, and you can go back and change it however you want, because of both sides of that are through your participation. So you can change that at any time to whatever you think is necessary to make it happen correctly.
Absolutely. All right. So gonna get my clicky thing to work here. I get too many buttons on the screen. Okay, here we go. So the taxation, the corporation, what we can, what the family limited partnership or the owner of the brokerage account can do, it can, as we mentioned, it can deduct the brokerage fees and the cost of trading, and that's really about all it can deduct. But if we have the corporation in place, now all of a sudden it can deduct computers and internet and cell phones. Do you need a cell phone to trade? Well, I can argue that you would. Do you need software? Do we need training? Do we need health insurance? All these types of things could be deducted, but we deduct it out of the corporation. We don't deduct it. If we were to, if you, a lot of you have used Charles Schwab or Morgan Stanley or Merrill Lynch, and they can do all these things for their employees because the legal structure and because they don't own the investments, they simply manage the investments. So we can't deduct those things at the family limited partnership level, but we certainly could at the corporate level. So we take the corporation, most likely we would elect to tax that as a C corporation, and the limited partnership or the LLC, we would tax that as a partnership. The structure allows the corporation to deduct expenses that you can't deduct as an individual investor. It also allows you to reduce the gains at the personal level, move them up to the corporation, where now I can deduct things that I couldn't deduct before. It's kind of a perfect scenario. And the point I want to make is you get to control, and this will change if you're at a growth stage of your life. You're young, you're active, and I just want as much money down in the brokerage account as I can do. I'm growing. Okay. But you might turn down the volume a little bit on your management fee because I don't need a lot of money in the corporation. But now I'm a little bit older, and now I've got more health problems. I've got inside of the corporation, it's agreed to pay 100% of my medical expenses, and I need a little bit more training, and I've got to do a little bit more traveling. I can increase those management fees as long as I stay within what's reasonable. It's a very flexible system. What is the corporation going to do? Well, it's going to buy and sell, and it's going to act as the general partner. It's going to deduct its legitimate business expenses, and it's going to charge a reasonable fee. What does the family limited partnership or the owner of the brokerage account do? We don't want it to do anything. We want everything after the corporation to be passive by nature. So it simply owns the investment, it retains or pays out, but it doesn't actively do anything. Therefore, all of if you pull money out of the corporation, you're going to pay self-employment taxes of 15.3%. If you pull money out of the family limited partnership, because I made good money this month and I've always wanted to go to Bermuda, and so I'm going to pull $5,000 out. That would be passive by nature. We don't want you to actively participate in the family limited partnership. How does the money flow in this situation? Well, if you were hiring an outside money management company, we would pull the money out of the family limited partnership to pay the corporation. The management fee is generally strategically planned to equal, oh, dang, I've got $20,000, $40,000 worth of expenses I can deduct out of the corporation nowhere else. My management fee might just be $40,003, and oh my gosh, yes, you are going to be doubly taxed on the $3. Live with it. But if
Yeah,
we can,
that's such a moot point nowadays, especially when you've got C corps down at 21% anyway. That double taxation, it really isn't that big of a deal when you figure out what you're really getting for all of it.
yeah, I've had a C corp for I think close to 18 years, and I've never been doubly taxed on anything because I never take a dividend. I'll take a salary, maybe at the end of the year, and I'll wipe out the corporation. Or I'll show a loss this year. That loss rolls forward. But people are so afraid of C corporations because of the double taxation thing. But believe me, you can get around that.
Yeah.
Mike, did you pay double taxes out of your C corp?
I haven't yet.
Yeah.
Yeah.
Yeah. Okay, so that's the duties, the ownership. What does the family limited partnership own? Well, it owns the bank accounts. So if you've got savings, this would be a safe asset limited partnership or LLC. It only owns things that are not going to create risk. So it could be billions of dollars in that one legal bubble because there's no inherent risk. But we would never want to put, let's say, a piece of real estate in it or an automobile, because then we've introduced risk into this otherwise safe bubble. Do we need lots of limited partnerships if we're going to have great big bank accounts? No, just one. As long as we don't introduce risk into it, it could own your precious metals and your collectibles and your artwork and anything, your IBM stock. It could own your brokerage accounts. All of that is owned there. The corporation, it's simply going to own the depreciating assets used to manage the business. It might own a computer and some office supplies, and it owns the sticky notes and a couple pencils and whatever you need, a calculator, your all of the depreciating assets. But if you're ever sued and somebody takes that away, it's like, oh, I don't care. The limited partnership is your asset protection tool, and nobody really wants your corporation because it owns a computer, a cell phone, and a couple reams of paper. That's what we're looking for. The family limited partnership. Who owns the family limited partnership then? Well, whoever contributed the assets. Now, I could gift an interest to my kids. Let's say each one of my kids, I gift them annually a 2% interest of the family limited partnership. They could do that. And I might give the corporation a 5 or 10 or 20% interest. We have to give it something. If it's going to be the general partner of a limited partnership, traditionally we give it at least a 1% ownership. So it's the general partner. But sometimes if I really need more money in the corporation, I invested a lot of money in a trading program, and I've got to pay that back, and I've got a lot of medical expenses. I might give the corporation 10% or 20% of the family limited partnership. So not only does it get the management fee, but it also gets 20% of the profits of the family limited partnership. It's a way to fund the corporation faster. Who owns the corporation? Well, whoever's going to manage the business, generally husband and wife, or a single person, you'd be the president, vice president, secretary, treasurer, and also the lone shareholder. And that's okay. There's nothing wrong with that. Mike, any comments on this structure?
Nope, that looks about right.
Okay. So now we add in another whole element to this, and who, upon your death or your demise or upon your incapacitation, who's now going to own the corporation and who's going to own the family limited partnership. So now at this point, we bring in a revocable living trust if we want these things to avoid probate. So what we do is, if you've got an existing corporation, we reissue those stock certificates, not in your name, not in Don Pendleton's name, but in Don Pendleton, trustee of the Pendleton Family Trust. And it says that right on the stock certificate. If you're setting up a new corporation, you can set it up right. But we don't necessarily want you to be the shareholder. We want your trust to be the shareholder. That way, when you pass away, all of your rights and interest in that controlling corporation come down to the trust. The trustee assigns that to somebody else, but it passes without going through probate because there's clear succession. Now, some of you go, well, how do I get a stock certificate? Go to Microsoft Word. All of you have that on your computer somewhere. It's a template. It's right on your computer. You just didn't know it was there, but it's a free template on your computer. There's a blank stock certificate. Put the name of the corporation and reissue those stock certificates in the name of your living trust. And it's a very, very simple thing that anybody can do without an attorney. Your limited partnership, or LLC, we could go back to the operating agreement of the LLC or the partnership agreement of the family limited partnership and add a simple little paragraph that says, in essence, Mike Coval owns an interest in XYZ family limited partnership. Upon his death, all of his rights and interest we want to go to, and there's a blank line. And you fill the blank line in, don't leave a blank. But as long as there's clear succession, and it could go to his children collectively, all of his 47 kids. How many? It could go to his son. It could go to his wife. It could go to the revocable living trust. And as long as we've got that and it's signed and notarized, then your interest in that limited partnership or LLC are going to pass without going through probate. Now, if you want everything to go down to the trust and let the trustee kind of divide things up equally among the beneficiaries, that's why we would do that. But it doesn't necessarily have to go to a trust as long as it goes to somebody who's still alive and willing to accept that gift. Designating a successor to your ownership of both the corporation and the limited partnership avoids those interests going through probate. I can't tell you how many times I've had people that have a successful business that's up and running, and then one of the partners passes away. Now, who owns that interest in that corporation? Well, it's going to go through 3 years, 5 years, 9 months of probate to figure out who owns it. And that value of the corporation is always much less after the courts have trying to figure out who owns the corporation or the limited partnership. Mike, any comments on that? I assume you've already done all this and you know exactly how this is all done.
Yeah, and just like you said, the funny one though is just with the stock certificates already on your computer through that. But no, you can go through all of this pretty easily. The revocable living trust is the big one to make sure you get that one set up last to make sure it's going through that. But no, so far so good. Quick question that somebody just had. It said met with I think CT for Connecticut asset protection lawyer who said that Connecticut does not recognize my family limited partnership. I heard that's now changed. Is that true? And while you were talking, Don, I just did a really quick Google search and found many attorneys in Connecticut that still set up FLP. So I'm not sure where that came from or
well,
why.
Here's the problem. If you go to any Secretary of State and tell them you want to set up a family limited partnership, they're going to scratch their heads and go, we don't know, we don't have family limited partnerships, but they all have limited partnerships. The family is just a designation to say it's owned by family members, but it's not a family limited partnership technically. It's a limited partnership owned by family members. So go, and there will be on the Secretary of State, Connecticut's, there'll be a certificate of limited partnership. Fill that out, and then the agreement that you're going to sign afterwards is going to designate who owns it. But you're absolutely right. The Secretary of State does not know what a family limited partnership is, but they do know what limited partnerships are. Okay.
Okay.
All right. So let's go one step further. So we're taking the same diagram, we're just diagramming a little bit different, and we're calling this your safe asset holding company. Again, that's a family limited partnership or a multi-member LLC filed in a state, hopefully that has really good asset protection. And for that, and I don't have a lot of time to talk about it, this is why we bring in Wyoming, or this is why we bring in Nevada, Alaska, South Dakota, Delaware, states that have really strong charging order protection, which means in a lawsuit, I can't take it away. The only thing I could do is put a charging order or a lien against your interest and wait for distributions to come out. And some states are substantially stronger than others. We're going to cover a lot of that when we get to the 3-day summit.
And what happens if distributions, Don, don't come out for years and years and years? What happens to the winner of that lawsuit?
Well, it depends on the state. For instance, in Florida, if you've got a single member LLC, Mike, what I could do is I could wait 3 years and then apply to the court to foreclose on your interest. And the court, if I prove my argument, will give me your interest in the limited partnership, or I'm sorry, in the LLC. Oh, because there was only a single member. Some states allow foreclosure if the lien is not being satisfied after 2 or 3 years. If they don't think that you're going to distribute within a reasonable amount of time, they're going to ask for you to foreclose. They ask the courts to foreclose on your interest. This is why we use states that are stronger, that do not allow a foreclosure. And they say that the charging order is the only legal remedy that you can do. They can't do anything. They sit there, they wait for a distribution, and if the general partner, the managing member, doesn't distribute, after 7 years, they reapply for the lien, but they're going to wait forever. And if you want to get really mean, we send them a 1099 for the money that they should have got, but we didn't give to them. And we start giving them phantom income, and they have to start paying the taxes on the money that we're never going to give them. So it's a anyway. Yes, but the answer to Mike's question is it depends on the state. And that's why, again, we like Wyoming, Nevada, Delaware, and some of the others we state. Okay. Now, some of you already have businesses, or maybe you have real estate holdings. And so on that, what we would do is we like single member LLCs when they're not owned by you, but when they're owned by a separate holding company. You notice what we're doing is we're separating the risky assets holding company from the safe asset holding company, because there's lawsuits that can happen in the real estate. And so we're separating the real estate from each other. We're either putting each property or each small groups of properties in its own single member LLC to separate the assets from each other. If somebody sues you, they've got to come to Wyoming where your holding company is held. It has nothing to do with your safe assets. And so what we're doing is we're separating the assets from each other. We're tying everything down to your trust. In this case, we would tax the corporation as a C Corp. The holding companies we would tax as partnerships. The single member LLCs don't file tax returns. everything would come, all the taxable events would come into that real estate holding company. So we could have hundreds of real estate and still with only 3 tax returns, one for each partnership, one for the corporation. It's really a beautiful way to simplify your taxes. And then the revocable living trust, of course, is a disregarded entity as well. It doesn't have a tax return. So that's basically how we would do structuring for a real estate investor. So Mike, what kind of questions are we having here?
Last one we just got, is Texas okay for this type of a setup?
Texas is really good, and it has really good laws for multi-member LLCs. It has really good laws for family limited partnerships. It does not, the statutes have never said whether they're going to give charging order for single member LLCs. So I wouldn't use that holding company here. I wouldn't use a single member LLC in Texas, but if a multi-member LLC, I would be very willing to do that. The one thing that Texas doesn't have, I guess the 2 things, they don't provide charging order for single member LLCs. And they also don't have good anonymity laws like Wyoming, Delaware, Nevada. Think for a minute who runs Nevada and who owns most of the assets. Well, everybody knows it's the mafia, but you can't prove it because in Nevada, you can have billions of dollars in Nevada corporations and nobody can tie it to your name or your social security number. Well, okay, so you don't have to be Bugsy Siegel to take advantage of the laws. Those are the laws in Nevada. I could have my broker, if these 2 holding companies were in Wyoming or Nevada, nobody in an asset search on you would never show those assets. That's cool. That's the one thing that Texas doesn't have.
Next question. Can you explain the difference between an LLC and a limited partnership?
Yeah, limited partnerships have been around since 1917. They've been up and down the Supreme Court, state court, federal court, district court, tax court. They've been all over the place. And there's lots and lots of case law on family limited partnerships. We'd like those for holding safe assets, just because of the judicial case law that's there. The LLC is the new kid on the block. It was created in 1977. It took 12 years for it to be adopted, for the IRS to figure out how to tax the little bugger, and they're still developing case law on LLCs. But we do like LLCs for holding real estate. And there's some passive tax laws. The IRS says, let's say property number 1 and 2 and 4 all made money this year, but 3 didn't. And what I want to do is I want to write off the losses against some of the gains and kind of equal things out. And the IRS, in their infinite wisdom, says if this holding company here is a limited partnership, we're probably going to deny, at least right off the bat, we're going to deny those passive losses. Where in an LLC, we're going to accept them. So whenever there's real estate involved, we never want to put our students in a position where they could lose passive losses. As an organization, we still like limited partnerships or family limited partnerships owned by family members, whatever. It's all semantics. We like limited partnerships for safe assets. We like LLCs for real estate. Hopefully that makes a little sense. Was that way too much information, Mike? Did I put anybody to sleep?
No. Another question for you. If you live in California and you have LLCs that are incorporated or they're formed in Nevada or Wyoming, do you still have to pay the California annual tax of $800 for each organization that you have?
Well, that's a really good question. And
I think the answer really is move out of California.
According to the California Franchise Tax Board, if you let's say this single member LLC number 1 that owns a piece of real estate over here is in Tennessee, and if you're thinking about that Tennessee LLC, you've constituted the act of doing business in California. You could be at 3 o'clock in the morning sitting there in your underwear, but you thought about it. Therefore, you owe that $800 filing fee. I would love to see one of our students that's a little wealthier than I am take the California tax board to task on this one and sue their little butts. And I'm confident that they would lose, but nobody's really taken me up on that yet. So we like the single member LLCs to be in the states where the property is located, so that you have standing in the state. You can evict tenants. If this property is in Tennessee, we haven't had problems with that. The problems have come from the holding companies, and as long as you're not doing business, we think that you're pretty good. If these single member LLCs, if the properties are in California, file them in California. Pay the $800 extortion fee. I'm sorry, the well thought out tax. That's kind of the cost of doing business. If the property is attached to California, pay the tax or use a land trust, and we can show you how to do that when you get to the summit. But file it in California. The safe assets and the holding companies, we think, can go out of state without filing them as a foreign entity and paying the $800. So that's been our experience, and Anderson is really good, and they have some written statements from the California Franchise Tax Board. They're better at this than I am for Californians.
Okay, here's one I have not heard before, so I'm not sure. Isn't the federal government proposing a new law to force beneficial owners to identify themselves to the government or the states where it concerns all entities in states that allow for anonymous ownership?
Yes, but they've been fighting Nevada for years and years and years and years. Remember, about 10 years ago, Nevada allowed bearer shares, which means I could own a corporation and it owns the stock, and I don't have to file anything with the state, tell them who the shareholders are. And let's say it's like cash. I assign my beneficial, or assign my bearer shares, I just give them to you. Now you own the corporation. Nevada finally backed down to the IRS and says, okay, we'll give on this, but so the federal government and the IRS is always trying to break through and find out who the beneficial interest owners, especially of Nevada, Wyoming, and Delaware corporations are. But there's enough kickback from the casino owners. They don't want that out there. I don't know. Yes, it's been an ongoing battle as long as I've been in asset protection.
Okay. What would you suggest, Don, that if somebody was just getting into investing, would be the first type of corporation? If they just, I'm just getting started and I want to make sure I've got something to be able to reduce my taxes and protect my portfolio. And one of the nice things, by the way, about an investment account is that if you don't do business with anybody else, you don't ever have to worry about being sued. But what would be the basic tax structure you would suggest for somebody if they're just getting started in the stock market? Without going through everything we just went through. Obviously, what we just went through here was the ideal scenario for somebody who's going to make sure their entire asset portfolio of everything is protected. But if they're just getting started in the stock market and I'm just going to, maybe make $20,000 my first year trading, investing, what would you suggest that I probably would start with?
You know what? If I'm going to spend some money on an education program, let's say I'm going to spend $3,000 or $4,000 and let Mike trade me and his really good team. I love their trading. As an individual, you won't be able to write that off. Is it worth it though to set up a C corporation for me so that I can write it off? And that would be up to you. Look at the cost of, okay, what am I going to pay in taxes on that $4,000 that I'm going to invest with Mike? Well, if I'm in a 15% tax bracket, so I'd pay $600. Is that worth it for me to set up a corporation, do the annual meetings, minutes, resolutions, pay for a separate tax return? There has to be a level of reasonableness to setting up the legal structures. We want you to save money on taxes, but consider sometimes there are free roads and toll roads in the tax structure, and sometimes, frankly, it's easier to pay the toll and just get there and get your training and get it over with. And then when you start making money, then we can increase the legal structure. So the two things that I look for and to be able to answer the question is, do I have a lot of medical expenses that I can't deduct anywhere else? And do I have a lot of educational expenses that I can't deduct anywhere else? If the answer to either of those is yes, I would probably set up a C corporation, or most likely it would be an LLC taxed as a C corp. Can I, Mike? You deal with more investors than I do. What
No,
do you?
I see both. I see we talk about both the LLCs and the Cs both for those. One of the things I do like though with the C is that just being able to use that to provide loans. If you need a loan for something, your corporation will go ahead and loan you that money. Maybe it's to get involved in some real estate as well that you're going to be trading with, that you have that ability to go ahead and loan that money out at favorable rates that you might not be able to get at a bank.
Can I do, before your next question, can I do just a little plug for the 3-day summit coming up next week?
Yep.
Oh, you know what? I forgot one last slide. I forgot this. So,
I was going to bring that up next.
okay. So what if I have IRAs and they have trading accounts or they have real estate? And I go, well, I need more money in my C corporation up there. Could my investment management company, could that manage my IRAs too? And thus I get more of a management fee and I get more money up there. So, and the answer is no. Just don't go there. Anything, if you're managing the corporation, which is managing your IRAs, that will be a prohibited transaction. Don't even think about it. So if all the money that you have is IRA money, you don't need a corporation. We just simply we don't go there. So I wanted to be clear on that. So there's so much we didn't get a chance to talk about tonight. How do we protect your personal residence? For a lot of you, that's the biggest asset that you have, and we'll cover that when we get to the summit next week. Isolating other businesses. How do we silo this business or my real estate? We're going to spend a huge amount of time on real estate and stock market, and we're going to spend a lot of time on estate planning. We're going to spend, I would say, a third of the class is going to be on tax reduction strategies, sources, and then in addition, sources of lawsuits. So if you're new to us and you've never been a part of the asset protection class, what we want you to do is tonight go to protectwealth.com/Mike and sign up for this summit. It is the longest running asset protection class in the nation. I know that it's a Monday, Tuesday, Wednesday class. I get that. It'll run from 9 to 4 Mountain Time, so you kind of figure out where you're at. And the theme of the class is a lifetime to accumulate, 3 days to protect. And I know it's a sacrifice to attend on a weekday, but some of the people, the powerhouse people that we're bringing into this summit, some of them I can't get on weekends. They're either too busy or they just don't work. We're bringing in the former senior trial attorney from the IRS to teach taxes. Aaron Adams has flipped, I think, over 10,000 houses. He owns real estate in multiple cities, every types of real estate. Clint Coons has done stock market investing and owns well over 100 rental properties of his own. And he's the most brilliant asset protection attorney I know. Stacy, Mike's sister, Jean Guarino will be there. I'll be there, and a special guest. We're bringing in the author of The Millionaire Next Door. What a kind-hearted gentleman! What a brilliant man! There's nobody that knows more about wealth creation and what's made America's millionaires other than Bill Danko, and he'll be here. And in fact, if you're attending all 3 days, we'll give you a copy of his brand new book, Richer Than a Millionaire. So there's an agenda. It's available at protectwealth.com. You can see it there. So if you're new to us, we're making this available to you tonight. Sign up for that class, and Mike will be there, Stacy will be there, we'll be there, and hopefully our technology will work better than it did tonight, and you'll be able to see us as well. Anyway, Mike, any comments about that? And then let's go to questions.
No comments on that. That sounds good. I think it's going to be some. Last time we had was just a great audience, a lot of really good questions, a lot of people participating, which is always better. The more questions you ask, the more you retain. It's okay just to watch and listen to the presentation, but if you've got questions and you can get those answered, you're using a different part of your brain. But one thing we didn't talk about tonight was any type of a retirement account or a Roth account, and those are both fantastic trading opportunities for the average investor. So you can just pretty much, for the most part, wipe out any taxes you might have to pay through your Roth account if you go ahead and set one of those up. Based on your age, under $56,000 a year, over $57,000 a year. But to be able to set those up and not have to worry about any taxes whatsoever when you take that money out, and there's no limit to when you have to take that money out. Some huge benefits of just using a basic Roth, and that's something you can just go online right now and just open up a Roth account with any broker you want and be done in 15 minutes, and it's already, and you're set to go.
Perfect. Absolutely, we recommend that. Yes.
Yeah. And I know I heard Scott talk about one time. I don't know, will he be talking about this as well? I thought it was a fantastic option. How to use it. If you've got yourself, if you set up some type of a corporation like we've been talking about here right now, Don, and then you go ahead and set yourself up profit sharing with company, because it's your own company, and you go ahead and set up profit sharing where you can get up to about $56,000 a year between what you provide and what the company provides to you. And then at some point you close down that company, or you want to change that over, you can now fund that over, send over to your Roth IRA. It's kind of a nice way of getting through that, $6,000 or $7,000 a year, all you can put into your Roth account to get it funded and get it up and started.
I haven't seen Scott's slides. He always gives them to me about a week in advance.
That's fantastic.
But because of the election, he's been holding off, going, who's going to win? Is it Biden? Do we talk about Biden's
right
tax law, or do we talk about Trump's? And so he's asked me if he's not going to give me his slides until Friday morning. So I have no idea what he's going to talk about. But I know that Clint will discuss that a little bit. And if not, we'll answer questions about using that trading company. If we can send a little bit more money out of our portfolio up to the corporation, yes, the corporation can spin off a little 401k or a little pension plan or a SEP IRA. And Mike's right, $57,000 a year could be going into your trading, into your account where you could trade more. Yeah.
Yeah, normally that might take you 10 years to get there, and you can get there in the first year. It's really a really cool setup.
Agreed. Yep.
I think Scott called it a backdoor way to get into a Roth or something like that, trap door or something. I'm not sure, but it was a great idea that I've been talking about that with some of the students in our classes as well.
Good.
The whole goal is, how do I go ahead and minimize that taxes? And at some point, let's be honest about it. Does anybody really think taxes are ever going to go down and stay down permanently? No, they're going to go up. And when they start to go up, what do you want to be able to go back and minimize? I want to minimize that tax that I have to pay. So if I can put that money into a Roth, and whatever I go back and trade, I can take that out tax-free with my profits when I start to withdraw that. That's a huge benefit, because let's say, 10 years from now, 15, 20 years from now, what tax rate do you think you're really going to be in? You might be in a 70% tax bracket for all we know. And to be able to make some of those trades on your portfolio and not pay any tax on that, and be able to live off that and not have to worry about what you're filing for your tax reports, huge advantage.
Yeah, so let's diagram that out for him, Mike. So let's say we've got $500,000 or $1 million family limited partnership or a brokerage account inside of your limited partnership, and we're sending up a reasonable fee to the corporation, and the corporation is deducting whatever it can. But what I don't want to do is I don't want to pay taxes on the amount of gains that I'm getting. So I send that money up to the corporation as a management fee. And then the corporation then funds off to the side a little pension plan for me. Ooh, that's cool. And so now what I'm really doing is I'm transferring the money. I can't transfer the money from the family limited partnership over to my my SEP IRA, but using this process, yeah, that's exactly what you're doing. And now it's in a tax-free environment where it can grow without capital gains. And if we set it up as a Roth, if we're setting this up in some type of a fashion where I could pay the taxes now or later, depending on the tax situation I want, it's a brilliant plan. Yeah, absolutely.
Yep, I
Good
agree.
question.
So many really cool things we can go back and do with all of that. You know, everybody says, you know, that we're going to be paying huge amounts of taxes and we're going to tax the rich, tax the rich. You know who writes the rules? The rich. You know who's in Congress? It's the rich. And so do you think they're going to write the rules so that they have to pay more taxes? The answer is no. It's never going to be that way, no matter whatever's promised. Question here from Tamara. I sell life insurance. Will I be able to sell life insurance through my C corporation if the C corporation's in Wyoming and I live in California?
No, because you're talking to people in California. You're hanging a shingle out in California. You're doing marketing in California to sell insurance. You really are a California corporation because, let's be honest, unless you, well, you're doing business in California according to all the definitions. Whether all of your clients are from California or they're nationwide or worldwide, the fact is you're doing business in California. So I don't know a way around that according to as I read the statutes from the California Franchise Tax Board. So for your personal investing, yeah, because it's not involving anyone, I'm not hanging a shingle, I'm not advertising, I'm simply managing my own accounts. Because of that, then I think you can get away from the Franchise Tax Board. But for your insurance company, I don't know a way around that. You're doing business in California. That's, again, the cost of doing business in your sunny state.
Okay. Another one, good information tonight. Will you put your precious metals, gold, silver, or any crypto investments you have in a limited partnership? And does that create asset protection on those?
Yes. In fact, we showed a slide on that where let's go back to this. Oh, I don't see which one. So the safe assets, yeah, right there. So the family limited partnership could own your brokerage accounts, your bank accounts, your precious metals, gold, silver, your collectibles, your artwork, just anything that doesn't have risk. So that's exactly the tool. So if you're going to keep gold and silver and you're not going to keep them in an IRA, that's exactly where we would put them for safekeeping.
Okay. What other questions we have through here? Kind of scroll down. In regards to the charging order, does the money that you were not going to distribute, I'm sorry, in regards to the charging order, does the money that you were going to distribute but did not distribute, does that money need to be in the account?
Yeah, yeah.
So let's say that you go through a lawsuit and somebody goes and they sue you, and you come up and let's say you owe them $100,000, and you're going to take normal distributions of $20,000 a year. Did you have to have that $100,000 in the account at that point of time?
No, not necessarily. Let's say there's $100,000 worth of profit that was made, and there are 4 owners, and I was going to get a 25% interest, or I have got a 25% interest, and I was going to take a $25,000 distribution. Whether I distributed it or not, there was $25,000 worth of profit that was made. So at the end of the year, there's going to be a K1 to each one of the 4 partners saying, here's your $25,000 tax you have to pay. But somebody had put a charging order against my interest. So their hand is on top of mine in the event there's going to be a distribution. So this K1, instead of going to me, because they have the legal right to receive that money, that K1 is going to go to them. We didn't distribute the money. Now could we distribute it out to everyone else? Yes. Could I, depending on the operating agreement or the limited partnership agreement, maybe I took it out as a fee for services rendered. Maybe I took it out as a loan. The money doesn't have to be there. The fact is that partnership made $100,000 last year, and the IRS wants that somebody to pay the taxes. And that may not make sense to you, but it really does, because you understand this concept. Let's say you've got $100,000 sitting in a bank account, and you put $100,000 in today, and it just sits there. You didn't do anything. You just let it sit there. At the end of the year, you're going to get a little 1098 statement from the bank saying, here's the $3.23 worth of interest you made. Do you have to pay taxes on that interest income? I didn't take the money out. Well, yeah, because you had the legal right to receive that distribution. Whether you took it out or not is irrelevant. Because you had the legal right, the IRS is going to expect the taxes on that interest income. The same principle applies to limited partnerships and LLCs. If there was $25,000 that was made in there, whether it's in there or not, the fact is that's the profit, and you owned 25%. You're going to get a tax bill for $25,000. Oh, wait. Somebody has their hand on top of my hand. They get the tax bill for the $25,000 that we're never going to give them. So the answer is no, the money doesn't have to be in the account. It just has to have been made. Was that a long-winded answer, or did that cover it, Mike?
I'll just have to go with that one.
Okay.
If somebody was thinking about investing now before the final results are called, would it be a good time to invest right now in the stock market?
That's for you, Mike.
Yeah, the answer is no. It's just, we just don't know where the stock market's going to go. It's going to be volatile. It's going to go up. It's going to go down. For the most part, it just really isn't worth it to have to jump in and take a speculative trade. If you're going longer term, that's okay to do. Something like ALXN, Alexion Pharmaceuticals, ALXN, good long-term concept for a stock. If you're just going to buy and hold, maybe write some cover calls on it. But for the average person right now, going into what we see coming up, we're going to see a lot of volatility in the stock market. And until we know exactly what's going to happen and where it's going to go, and that means, at least for the next week, let it play out, let it do whatever it's going to do. And then from there, we can go back and say, now, how do I want to go back and invest? Otherwise, if you're going to say, I just have to invest because you're just getting nitty gritty and you're going through withdrawals and you think I can't stop, not trading, invest in good long-term companies where you say, I'm just going to buy it and hold it. I don't care if it goes up or down 5 or 10%. Apple would be another one of those stocks, AAPL. Just because it's never going to go bankrupt. They've got more cash in the bank than most countries do. And so, another buy and hold, and then eventually you can write some cover calls or use that as collateral for some other trades. But otherwise, it's okay to stay away from the stock market for the next week or so until we find out exactly what is going to happen. Let the volatility play out, and then let the big institutions tell us what they're going to do. If it sells off and all of a sudden they start buying, then we'll buy with them. If they continue to buy like they did today, then we can go ahead and continue to buy with them. But we need to let them tell us what we're going to go back into in the stock market. So it might be a good time then to actually go back and set up a corporation if that's what you want to do, and kind of get into that while you're waiting for the stock market to settle down. Apple and Alexion Pharmaceutical are two I like right now, ALXN.
It might be a really good time to get your structure in place, so that
if you're busy working on something and doing something, you're not focused on what the stock market's doing, because you're focused on, I have a task at hand. I'm going to go ahead and get my C corporation up and running so that I can go ahead and start trading. I want to make sure the bank account's opened up. I'm going to make sure I get all the information that I might need. And then so I can then go ahead and fund the account, wait 5 or 7 days for that money to clear so I can then go ahead and start to invest.
Great. Again, if you haven't signed up for the 3-day summit, go ahead and do that tonight. protectwealth.com/Mike. That way we know that you came off this webinar, and we're not going to treat you any better or worse. We're just going to treat everybody the same, but it helps us track where our students came from
Yeah, at that class, by the way, Don, we'll also be doing a live trade, maybe 2 live trades at that class. So even if you're not going to do anything else, but you want to see how professionals actually trade, come to the class and watch us. We'll pull out another live trade, and we do a live trade at every class, and we've made money on every single class that we've done with you, Don. We've made money on every single one of those trades.
Is that right? That's cool.
Yep, every single one.
Well, my trading account's done very well based on what you and Christine have taught me, so I appreciate it very much.
Yeah, so we're looking forward to having you there. Last class you did was a nice one for everybody involved. A lot of good questions, and bring questions if you've got questions. Like somebody had a question here earlier tonight, that their broker told them this, or that their financial planner told them this for the state of Connecticut. That was a good one. Bring some questions. If you're going to hear all kinds of stuff when you go back out and you hear from professionals what it is you actually should do, whether it's open up this type of corporation, do this type of a trade, buy this type of a home, use your IRA account. You're going to hear all kinds of people tell you what you can and can't do. And really what they're saying is they don't know how to do it. So if you really want to know what you can or can't do, talk to somebody who actually does it. Talk to Don, talk to Kendall, talk to Scott Estel, Anderson Advisors, talk to Aaron Anderson, talk to me or Stacy, people who actually do this for a living, and we'll tell you what is really feasible and what can be done and what can't be done. But don't try to get your information secondhand from somebody that doesn't really understand it. Get it from somebody who actually does this for a living and is successful at it. And that's really what we're after. So come to the class this next week. I think you're going to have a good time. Bring lots of questions, because Don usually gives me a time to answer questions on the second day as well, or third day, which is just flat out just questions that you might have, and I'll be happy to answer those for you.
Great. All right, I see one more question here. Kamara is asking, can the K1 from stock bonds offset depreciation? So can real estate losses offset stock market gains, or vice versa? And the answer is yes. What the IRS is looking for is the short-term gains can offset each other, and then long-term to long-term gains. And after that, so the answer is yes. If I've got a lot of depreciation from real estate and I made a lot of money in the stock market, can those two offset each other? And the answer is absolutely yes. So Mike, are you seeing any other questions?
One I was just answering right now, it was just, if we're in the stock market right now, would you consider getting out, or what would you do? No, I wouldn't get out right now. I just hold. If you've got some good quality investments, it's like having a house that you have. Sometimes the house will go up in price, sometimes it'll go down in price based on what sells in your neighborhood. Stock market does the same thing. But if you've got good longer term investments, just leave them there. I would just hold off on buying anything new until we find out what the large investment companies are going to do, what Wall Street's going to do. They'll tell you. They'll say that, now that things are going to change, if Joe Biden wins the presidency, we're going to probably go back to more of a lockdown. That just means more of the companies that do home education type of things will start to pick back up. There's always going to be some winners that are out there, and that means a lot of tech stocks, a lot of NASDAQ type of stocks are going to do well. And the reason for that is because of the technology that's in a lot of the systems, computer systems, things like that, semi-chips, that kind of stuff. But there's always going to be winners in the stock market. Wait till Wall Street comes back and tells us what they're going to start looking for, and then we'll just jump on the bandwagon. It takes them if I'm a big institutional fund and let's say I'm managing $6 or $7 billion, I can't buy what I want in a day. It takes me months to buy. So, but we as investors can see what they do, because you'll see big volume spikes on stocks they start to buy. We can buy in 3 seconds, but they're going to have to continue to buy for the next 3 months. So it gives us a huge advantage. So let them tell us what they're going to do, and then we can go back and jump in it right after them.
The thing that I've learned from working with Mike is that there are strategies for every type of market. And if you only know 1 or 2 strategies, you only know how to make money when the market is going up, you're going to be very limited, and you're going to think, oh, there's a horrible time to be in the market when the market corrects and it goes down. But if you understand more strategies, and that's what I love about working with Mike, is that he can make money when it's up, down, sideways. I mean, it's going to move one way or the other. And he just knows how to make money, and it's not that it's a bad time to be in the market. It may be a bad time for that strategy, but it's never a bad time. There's always going to be people making money.
Yep. No matter what happens, Wall Street's not going to go away. That's where all the money's at. Think about how much money's on Wall Street. You ever bought a car? You ever bought a house? Where'd all that money come from? You got a credit card? Everything starts with Wall Street. It's never going to go away. It's going to be the last thing standing. So it's always got the opportunity to make money, whether the market goes up, down, or sideways. You know, your car has reverse. Your car's steering wheel goes left and right. Stock market's the same thing. Doesn't matter which way it goes, as long as it's moving, that's all we're after.
Great. All right. Well, so Mike, are there any other questions that are looming here that we need to answer?
Nothing that's looming right now, but it was a lot of good information on tonight. I liked it, Don. You had some good stuff on here. I would say that the first part, though, is just get yourself to the class this week coming up, just so you can hear all the different speakers and find out what's best for you. You might find out that maybe you don't need everything Don talked about, because maybe you're more into just real estate and you might find something else that works well for you, or maybe you just want to get yourself some type of a living trust set up so that if anything happens to you or your family, you know where the money's going to be distributed, or maybe it's going to be a C&S, an LLC, whatever it might be. We're going to cover all those different topics this week coming up. Plus, you're going to hear from some of the best investors out there, you know, in real estate and stock market and other properties as well. Well,
Mike,
great stuff. I'm looking forward to it.
Absolutely agree with you. I love legal structures, but I never want to put people in a position where they're overwhelmed by, oh my gosh, and the legal structure limits their ability to go out and make money. We want this to be an asset. We want this to be a tool that you use to help build and protect your wealth. We never want it to be, oh my gosh, overwhelming. We want you to be wise and prudent, resourceful. We want you to understand the risks that are out there, because we really do live in a volatile, litigious market. You need to understand that.
Yeah,
But
and I think it's only going to get worse.
Yeah, I think you're right.
Yeah.
But we never want to overdo with people and create a legal nightmare that they can't. We want to keep it wise, prudent, and responsible. Yep.
Yeah, Don, you like legal structures. I like making money.
I like making money in my legal structures. How's that?
The question here from Kumar, how do you get in contact? Just go to protectwealth.com or protectwealth.com/Mike for my first name, Mike. And you can get in contact with us there, Kumar. And then hopefully we'll see you guys in just a few more days next week. We're going to be a great class coming up.
Thank you very, very much for your time this evening, and especially thank you to Mike for his time. We know it's very late on the west or on the East Coast. We appreciate you sticking around with us. Thank you.
Thanks, everybody.
And everybody, have a great night. Thank you.
Okay. Bye-bye.